Stop scrolling. Right now, while you were watching financial news tell you silver's rally is topping out, the Bank of Japan just spent $35 billion punching the US dollar in the face. And silver answered in a single trading session with a 3.47% surge. But here's the thing, nobody on cable TV is connecting for you right now. And I mean nobody. That dollar punch from Tokyo? It didn't happen in a vacuum. It happened 48 hours after the most divided Federal Reserve vote in 34 years. An 8-4 split that the major networks buried under footage of Jerome Powell's farewell handshake. The handshake was the magician's left hand. The fracturing Fed was the right. And while both hands were waving, physical silver was quietly walking out the door. By the time this video ends, you'll understand exactly why the number you see on Kitco right now is the most misleading data point in the entire financial system, and why the next major move higher in silver is not a question of if. It is a question of which trigger fires first. Let me give you the scoreboard as of Friday, May 2nd, 2026. Silver spot sits right around $76 per ounce, up roughly 3.5% on the day, up 4.4% on the month, and up more than 138% compared to 1 year ago. Read that last number again. 138% in 12 months. And yet Bloomberg ran a segment this week explaining why the rally was exhausted. The price went up fast. That proves it's a bubble. The price pulled back. That proves the bubble popped. Heads they win, tails you lose. Meanwhile, gold is trading near $4,600 an ounce. The gold to silver ratio sits close to 60-1, still massively compressed compared to historical norms, which means silver is still the better value bet relative to gold by any long-term measurement. The dollar index broke down from the one-week high it built heading into Wednesday's Fed meeting. And the reason it broke is the story nobody properly told you. So let me tell it properly. Wednesday, April 29th. Jerome Powell chairs what is almost certainly his final FOMC meeting as Fed chair. The vote comes in 8-4. Rates held at 3.5% to 3.75%. 4 dissenters. That is the most divided Federal Open Market Committee outcome since late 1992. 34 years. Now here's the split that matters, because it wasn't simple. Governor Stephen Moran voted to cut rates by a quarter point. But the other 3 dissenters, Cleveland Fed President Beth Hammack, Minneapolis Fed President Neil Kashkari, and Dallas Fed President Lori Logan, they voted in the opposite direction entirely. They wanted to rip the easing bias completely out of the official statement. In plain English, 3 of 4 dissenters think the Fed's language is still too dovish. They want the door to future rate hikes left open. Dallas Fed President Logan said publicly that she is increasingly concerned about how long it will take inflation to return to target, and that the Middle East conflict raises the prospect of prolonged or repeated supply disruptions. She believes the word cuts should not appear anywhere in the Fed's forward guidance right now. That's 3 regional presidents, not fringe voices, not dissidents, publicly warning that the next move might not be a cut at all. And the market heard it. The dollar caught a bid on Wednesday afternoon. That was Powell's farewell gift to the institution, a hawkish-leaning hold designed to firm up the dollar and hand his successor, Kevin Warsh, whose nomination just cleared the Senate Banking Committee, a market that still respects the Fed. That was the trap. And Tokyo sprung it. Thursday morning, Tokyo time. The yen has been getting crushed for weeks. The US-Iran war, the near closure of the Strait of Hormuz, and spiking oil prices have driven the dollar-yen rate past 160, a level that when it was hit in July 2024 triggered the last major Japanese currency intervention. Japan issued a warning, then another. Then Finance Minister Satsuki Katayama said officials were approaching decisive action. And then they acted. Reuters, citing 2 sources familiar with the matter, reported that Japanese officials stepped into the FX market and began buying yen, selling dollars. Central bank data confirmed Japan may have spent as much as 5.48 trillion yen, roughly $35 billion, in that single intervention. The yen surged as much as 3% against the dollar within hours. Japan's top currency diplomat Atsushi Mimura went on record Friday morning saying speculative positions remain in the market, essentially putting traders on notice that they are not done. Multiple analysts, including Jordan Rochester of Mizuho Bank, said in a published note that more intervention is likely imminent. The options market is already pricing a second round. So let me map this out clearly. The Fed fires a hawkish hold. Dollar firms. That's the trap. The Bank of Japan fires back with $35 billion of intervention. Dollar breaks. Yen rips. That's the backfire. And physical silver, sitting in warehouses and safes and vaults around the world, does what physical commodities have done at the end of every major debt cycle in history. It moves. Here's where we go deeper than the headlines. Because the dollar weakness is the spark. But the powder keg was already packed. The Silver Institute's most recent forecast, released April 15th, confirms a 6th consecutive annual supply deficit. This year alone, the projected shortfall is 46 to 67 million ounces. And that is on top of more than 760 million ounces drawn from above-ground stockpiles since 2021. Nearly a full year of total global mine output gone. As of first notice day for the May contract, Thursday, April 30th, over 17,900 contracts were still standing. That represents roughly 90 million ounces of paper claims against approximately 76 to 77 million ounces of registered deliverable silver in CME-approved warehouses. The coverage ratio, the fraction of paper claims that could actually be physically settled, sits below 15% for the sixth consecutive delivery month. Not once in 6 straight cycles has it improved. To put that number in perspective, the registered silver pool is 64% smaller than it was in April 2020. Gone. Drained. Cycle by cycle. AI hyperscaler capital expenditure commitments from Meta, Alphabet, Microsoft, and Amazon total $715 billion for 2026, according to Trading Economics. Last year, that number was $375 billion. Nearly double. Every server rack, every AI accelerator, every new data center consumes silver that does not come back. It gets used. It doesn't get recycled at scale. JP Morgan's own commodity research desk projects an average silver price of $81 per ounce for 2026. Their average is higher than where we are right now. The LBMA member bank survey for 2026 has a price range that tops out at $165 per ounce. The institutions running the paper game are quietly admitting, in their own published surveys, that the floor is substantially higher than what your Kitco app shows today. Keith Neumeyer, CEO of First Majestic Silver, stated publicly just days ago that silver is in a new price regime. He said the market is creating a new pricing paradigm, and there's no returning to the historical levels we've all been accustomed to over the past 2 or 3 decades. Ole Hansen of Saxo Bank, commenting this week on silver's long-term prospects, noted clearly that supply shortages and stable industrial demand continue to build a structurally bullish case for the metal. The paper price and the physical reality are 2 separate markets. They only reconcile on delivery day. I don't do vibes. I do data. Here are 3 specific, falsifiable predictions tied to real triggers, things that will either confirm this thesis or break it. Silver needs to clear and close above $79.30 on a daily basis within the next 10 trading sessions. If that happens, the next magnet is the March 11th high near $87. Above 87, the path opens toward the March 2nd high around $95. And above that, the door reopens toward all-time highs. Today's move is the first clearly bullish technical setup since the late January breakdown. The structure is rebuilding. But 79.30 is the gatekeeper. The Bank of Japan rarely intervenes once and stops. In 2024, they followed their first major FX action with a second, smaller round within 48 hours. Multiple currency strategists expect another Japanese action next week. Combine that with Fed Governor Stephen Moran, the lone dovish dissenter, speaking publicly in the days ahead, and you have the setup for a multi-week window of dollar softness. Dollar down, silver up. That's not a prediction. That's a mechanical relationship. The COMEX registered silver inventory continues to bleed. If the registered pool falls below 70 million ounces before Memorial Day, and given the trajectory that math is straightforward, the coverage ratio drops into the single digits relative to outstanding paper claims. At that point, a single significant institutional player asking for physical delivery doesn't just strain the system, it breaks it. And when that break happens, not if, when, the price adjustment is not gradual. It is not a polite linear move to $100. It is what market technicians who study structural repricing events call a violent gap move. Days, not months. Now I need something from you. 3 things. First, subscribe right now. Hit the button below this video. Not because I'm asking nicely, but because this channel exists to give you the framework before the event, not the recap after it. There are people who heard about the 2024 BOJ intervention after it happened. Don't be that person for what's coming next. Second, drop your prediction in the comments. 1 number. Where does silver close on Friday, May 9th, 1 week from today? Above $80? That tells us the technical breakout held and the dollar weakness extended. Below $72? That tells us the paper market bought itself another week. Post your number. The closest call gets a dedicated shout out in the next video. And if you're an OG who has been stacking since silver had a double-digit handle, drop OG plus your city. Chicago, Houston, Phoenix, Austin, Dallas, Denver. Let the algorithm see exactly how large this community actually is. Because every one of you who shows up in those comments is proof that the so-called fringe isn't fringe at all. Third, share this video with one person, just one, who still thinks the COMEX price they see on their phone is the same thing as physical metal. Because it isn't. It never was. And the gap between those 2 realities has never been wider or more unstable than it is right now. Here's what I want you to leave with today. Jerome Powell is not the protagonist of this story. Kevin Warsh is not the protagonist. The 8-4 vote is not the protagonist. The Bank of Japan's $35 billion intervention is not even the protagonist. The 76 million ounces of registered deliverable silver sitting in those COMEX warehouses, that is the only number that has ever mattered. And it gets smaller every single delivery cycle. The deficit is real. The industrial demand is real. The currency war between Tokyo and Washington is real. The fractures inside the Fed are real. And the price is finally starting to tell the truth. Stay sharp. Stay stacked. See you in the next one.